In this video, I wanted to point out all the little details that were hidden within SoFi's earnings call. So I actually got a copy of their earnings call transcript and I've highlighted all the key features, whether they're big or small. I want to talk about it all in this video. But before we get started, okay, this is the way we're going to do it. We're going to actually bring up the transcript here and just talk about everything, all the different highlights. I've highlighted it all, but I want to know, do you guys want the white screen or do you guys want the dark screen? I'm going to go dark for this time, but for next time, please let me know in the comments down below what you guys would prefer. That way I'll just do whatever you guys like. So just to start off, there's really only going to be two main people speaking. That's going to be Anthony Noto, the CEO, and then Chris Lapointe, who's the CFO. All right. And then a bunch of myriad of different people that come from different banks. They're the actual analysts of SoFi. Obviously, they just get into how this conference call is going to go, normal stuff. It really only starts to get into it once Anthony Noto starts talking. And that's whenever he just highlights everything that we saw from last year. So we saw, record fourth quarter adjusted net revenues of around $280 million, up 54%. I covered this in my last SoFi video. But then, he talks about how they've seen growth in all three of their categories. That's their lending side, their financial side, and then their technology platform. He even goes to break it down in terms of adding how many new members, right? 523,000 new members, an absolute record in terms of numbers, impressively up 37% for the amount added since just Q3. So just quarter over quarter, and an absolute number was 39% higher. We even see new product ads of around 906,000, up 51% versus just the third quarter ads, which is just unbelievable. And then they even finished 2021 at a record of 5.2 million products. That's people having, SoFi Money, SoFi Invest, a home loan. That's 3 products for one customer, right? So they were able to actually double it, more than double, 105% year over year on just their product side. And then Galileo obviously grew around 67% to 100 million customers. And they're also taking on a myriad of new customers as well, like different partners. All right, but all that stuff is just criteria that we've already covered. What I want to talk about are all these bullet points. Now we're going to go over them pretty quick because obviously it's extremely long, okay? And we don't have that much time. So let's just talk about this. These are the most important parts that have actually come out of this quarter. So one thing that I want to talk about is SoFi's unique financial services productivity loop strategy, okay? You might also hear this if we talk about it later, the FSPL. That's also what it would be referred to as well. Well, this allowed us to actually exceed our original 2021 member targets by 40%, and most importantly, still hitting our EBITDA target, okay? So instead of just, going out and actually sending out a bunch of high cost marketing tools, maybe like something like commercials or something, what we're actually doing is just growing our member base through referrals, which are actually really, really low cost targets. But then just going into just lending here, we grew segment revenues for lending by 30% year over year in the fourth quarter, or 42% for the full year, even though there was an unexpected extension of the federal student loan program. This severely hampered the amount of money that we're going to make, even though we still hit our targets. That just goes to show you how good Anthony Noto is actually at excelling what he's supposed to do. So whenever that does start back up, which should be May 1st, we should see even better performance. But Q1 and a little bit of Q4, which what we just saw was a little bit hindered because those numbers got pushed back. But that was just our student loans. Whenever we actually pivot and look at personal loans, we saw a record of $1.7 billion, which is up 168% year over year. And this is the great thing. We're actually allowed to just pivot over our business whenever there's like maybe a problem with another product that we might have. And then just another really interesting fact is what they're calling lending as a service partnership with Pagaya, which nearly added around 7,700 referred loans across a broader audience while still maintaining our credit criteria. What this means is that our partnership with Pagaya actually allowed us to, because we only take on like really, really prime clients, but a whole bunch of people, around 70% of the people were still applying for loans, even though they didn't actually meet our criteria. Now we just use them and send them to a different company that actually Pagaya deals with, right? So they take on the credit risk, they take on all that, and we actually take lead generation. And then just going from all the other segments of lending to our last one, which is home loans, which is our smallest, but still, we had increased purchase home loans from low single digits to low double digits as a percentage of SoFi's total home loan volume. We saw accelerated demand in the fourth quarter ahead of our January federal student loan payment moratorium deadline and anticipated rate increases in 2022. They're anticipating rate increases, okay? We originated nearly $1.5 billion in loans, up more than 50% sequentially. That's quarter over quarter. Now, this next part's pretty exciting, okay? We expect continued strong growth in our lending driven by the momentum that personal loans are bringing us. They also talk about how the student loan program is also ending, right? So that should bring more growth in the actual student loan side. And then home loans, they even say they're trying to do better positioning in home loans, and they have many opportunities because of the new banking license that they have. Now, next we have financial services, and they say that they've actually seen a large step up in monetization that drove record revenue up nearly 2 times just quarter over quarter, okay? Because they added 857,000 new financial service products in the fourth quarter, which is actually up 56% just from the amount of ads that they added from Q3. Now, for the year, they've added around 2.5 million new financial service products, which is actually more than double the 1.2 million that they added in 2020. Through better monetization, okay, because they're actually squeezing out more money from all the people that are using the financial service products, they actually produced 5 times more year-over-year increase in the fourth quarter to total financial services revenue of $22 million, as well as a full year revenue of $58 million. So really, the problem is this, okay? That $22 million out of the $280 million that we made this quarter is such a small fraction, okay? And so although financial services is growing so much faster, it still makes up a fraction of what we're doing in the overall business. But what's really interesting is the fact that it 5x just year over year. So if that continues to grow that much faster, financial services could blow past our lending segment if we continue to onboard so many people into SoFi Money, SoFi Invest, and all these different products. But anyway, let's get back to it. They even said that they're having a lot of, product improvements. They added 25 new cryptocurrencies, making SoFi a selection leader with over 20 at the end of the year. Now, they're not comparing themselves to Coinbase or something like this. They're comparing themselves to other banks and other big fintechs that are able to offer these sorts of things. They also talked about other products that they're doing, like IPOs, which first they did Rivian, and then the second one that they actually did was Nubank. So just other things to actually increase the amount of monetization. But then we look at SoFi Money, which they actually introduced, 2-day early paychecks, auto save, cashback, and no fee overdraft protection. And with our launch of SoFi Checkings and Savings, we now offer members 1% annual interest, which is about 33 times the national average, plus no account fees or minimum balances. Then they even say here, their SoFi credit card, which actually, it doesn't say here, but I'll just tell you, it was around 6,000 accounts last year. They now say that quarterly spend balances and accounts grew at high double digits, and we finished 2021 with 91,000 products, 91,000 different credit cards, okay, from 6,000. That's like a 1,400% increase. Then going on to their technology platform here, Galileo actually benefited throughout 2021 from growth in enabled accounts, transactions per account, and adoption of new products by existing partners. And then they also just saw new partners as well. So we're taking these existing cohorts that we have and we're growing them in 3 different directions, but yet we're also creating more new clients. So it's just a growth phenomenon right now. That led to full year Galileo results of 2021 revenue more than doubled to $195 million. Now, in terms of who those new partners are, which they don't really talk about in the earnings presentations, are like right here, what they talk about. We also grew Galileo's total, business-to-business client base by 40% in 2021. We launched Toast last year and signed T. Rowe Price in the fourth quarter to serve its future emergency savings program. They also added on H&R Block. This is the one that they're super excited about. I don't know how much, H&R Block actually has a banking audience if they're just doing taxes, but supposedly new mobile banking app called Spruce. And then just adding on to that, we also have Technesis, which supposedly they were going to be hopefully done by Q2, but we've already finished the actual acquisition of Technesis, so it's done. We don't have to worry about that anymore. And is the next step in vertically integrating SoFi's business to further accelerate the pace of innovation and our best-in-breed financial products. We expect Technesis to be a growth multiplier for both SoFi and Galileo, okay? In addition to realizing its own enormous growth opportunities, which has further strengthened its partnership with Galileo. And then just last, they say, we are on our way to building the AWS of fintech, all cloud-based native financial products that are all on one system that can now be hosted all through what Galileo has, what Technesis has, all under the SoFi name. Just beautiful. Now, just back to that financial services productivity loop. I know we'd see it again. Creating best-in-breed products that build trust and reliability with members, which increases the likelihood that you choose SoFi for a second or even third product. When they do, we benefit from increased LTV. That's lifetime value of a client, okay? Per member by generating more revenue at little to no customer acquisition cost, okay? This is like saying we get a customer with, a checking account or whatever, and then we offer them an investing account or a credit card or a loan or something like this, but we've already spent the money to get the initial client whenever we got them on SoFi Money. Everything else was just gravy, and we can actually get them into our higher revenue products. So the more products that we're able to add on, like new cryptocurrencies, new, lending products, all these sorts of things, just increases the LTV of our existing client base. As a result, our higher LTV allows us to invest in more differentiated products and services, which truly drives more demand and higher LTVs. It's a true competitive advantage. I had to highlight that because it's so true. This is why I love the financial sector, because once you actually have them on your platform, it's so easy to expand from there and at a practically zero cost to actually do so. And you can see that it's working right here. Fourth quarter cross-buy volume more than tripled year over year to more than 380,000 products. And more than 1/3 of those new products were adopted by existing members in that quarter, contributing to a 17% decline in our customer acquisition costs in 2021. So once we actually, get these existing clients, we can grow so much thereafter. So this is why it's so important that we look at member growth as if it's growing our lending base, because although it might not be right now because maybe they're young clients, as they start to get older and older, those personal loans become more needed, or home loans or something like this, or we can even get into, larger like mortgage lending, right? And then this is going to become so important for us. Even though we got them at the cost of something very low way back in the day whenever they were just wanting to buy a couple stocks or ETFs. And then you can even just see here that they also said that they dramatically increased SoFi's unaided brand awareness with an unmatched reach due to SoFi Stadium. Okay, they put it into perspective here with real numbers. Five nationally televised regular season games at SoFi Stadium were seen more than by an average of 22 million households per total. That alone increased SoFi's unaided brand awareness by nearly 70% in 2021 to a total new record in the fourth quarter. And that was before an estimated 106 million people tuned in to watch the Rams win the Super Bowl at SoFi Stadium. Then just skipping along actually here to Chris Lapointe, who's the CFO, okay? He actually says, our original 2021 plan and what we guided to process was $980 million in adjusted net revenue. This is what they were supposed to do, okay? That was before they actually knew that the student loan program was actually going to get pushed and it was going to expire on September 30th, 2021. It also included a full year of revenue recognition from our equity investment in Apex, which was called last January. Despite the 50,000 plus of revenue headwinds created by those two factors alone, we still exceeded our original revenue plan by over $30 million. They saw two massive mistakes and still outperformed what they were going to originally. But anyway, segment level performance where growth accelerated was across all three segments. They didn't mess up anywhere. In lending, fourth quarter adjusted net revenue grew 30% year over year, or to $208 million versus the 21% in Q3 of 2021. Then, just skipping along here just a little bit, what we also see is that expenses were higher in the student loan refinancing business, where we increased marketing to capitalize on elevated demand in the lead up to the January 22 federal student loan payment moratorium expiration. This is where the moratorium was unexpectedly extended to May 2022, okay? They lost about a week worth of revenue from anticipating the federal student loan funding and had already spent the marketing dollars. There was nothing they could do at that point. Then, just talking about Galileo, I should have highlighted this, but what they saw was $53 million in this quarter from Galileo, which is up 42%, okay? But yet they saw 67% in the amount of accounts that grew up to 100 million. I don't actually like this answer. They said, it's normal to see a lag between the addition of new accounts and the engagement and monetization of those accounts. We are encouraged by this leading indicator of Galileo's growth. I mean, obviously that makes sense that there would be some sort of phase into the amount of money that you're going to make from those accounts, but the 42% doesn't make sense because obviously whenever we actually look at this page, if you guys remember, and I mean, my face is a little bit in the way here, but we have 67% here, 81% here, 119% here, 132, 139, 133. Where is there slow growth? Like maybe I think the actual revenue should be higher than the amount of counts that grew, not lower. Because if it is a lagging indicator, where's the lag? Like if anything, the slower amount of growth is in the member category. We should even have higher members if it is a lagging indicator. Regardless, it still is amazing growth, but I just don't know if that the revenue is actually catching up to what, the member growth should be at. I think maybe we're actually getting less and less amount of monetization per client, but still growth is growth. And I'm very, very excited about it. It's still 42% is amazing. And probably some of this explanation actually comes here where they said, this one quarter does mark the beginning of a trend. We plan to operate the business in the 20 to 30% contribution range for the foreseeable future as we continue investing to take advantage of the opportunity ahead of us. They could actually run the tech platform at closer to a 40 to 50% contribution margin like they've done in the past, but they've probably lowered it to try to grow as fast as they can. But regardless, on to the financial service segment. All right, this segment delivers revenue of $22 million in Q4, like we spoke about, more than 5 times more than the prior quarter at just $4 million, or up just 74% quarter over quarter. This is what I'm talking about by, although it is a sliver of what we're making in the business overall, going up 74% just quarter over quarter could really start to get compound itself into something really meaningful in this business. Like they say here, listen to this compounding growth, okay? Our year over year revenue growth was twice our exponential product growth of 2.5 times, okay? Demonstrating our continued progress in monetization. So not only did they put out 2.5 times as much product, but they also put out 5 times the amount of monetization. So that ball, if it continues to roll that way, is going to get massive. That being said, contribution losses were around 35 million for this quarter, which, well, that is a slight improvement year over year. We remain in investment mode, focused on creating the right unit economics for each business to drive long-term sustainable growth. Now, they talk about their balance sheet here, right? Balance sheet, which grew approximately $600 million year over year to $9.2 billion in total. We exited this year with $1.6 billion drawn on our warehouse facilities, less than 25% of our overall $7 billion of capacity. Now, warehouse facilities are something like a big credit card for big businesses, okay? It's what they could lend off of, but they're not even using that. They're trying to stay away from all that capital. They're only using about 25% of the debt that they actually could dive into right now. That being said, our total book value was around $4.7 billion, and our capital and leverage ratios are extremely strong. Now, this is an old piece of news, but it's still good to understand that on December 6th, we redeemed all of our outstanding SoFi Technology private and public warrants, which just also goes to benefit their P&L, which is very, very exciting. Incremental net interest income from SoFi Bank will only contribute nominally to Q1, okay? The results prior to the fully originating loans in the bank, which we expect to have done by May of 2022. I'm actually going to zoom in just so then it makes it a little bit easier on your guys' eyes, just in case if you're on your phone or anything like this. Full year 2022 guidance, we expect to grow adjusted net revenue by 55% year over year to $1.57 billion and deliver adjusted EBITDA of $180 billion. So although Q1's not great, the other 3 quarters must be fantastic for them to pull off this much growth. And then just going on, they even say that, assume that SoFi Bank will actually be beginning contributing to SoFi's results more meaningfully in Q2, not Q1. So don't look out for that in the short term, but it should start to add in Q2. And then assuming that the Technesis revenue growth will be around 20 to 25% for the full year and start contributing to our business following the close of this transaction. That's already happened, by the way, if you're watching this today. And then just going on, they say Technesis will actually contribute to a small amount of EBITDA in 2022, but over time, we expect this business to be an additive to consolidated incremental EBITDA margins. What a mouthful, but it is true. All right, now we actually go on into the question and answer section, okay? So I've highlighted just the main questions that they actually ask here. This is from John. So John says, what drove that in terms of customer acquisition channels or customer acquisition costs? And are there any changes there? Anthony Noto answers a little bit, but it's nothing that we haven't already spoken about in this earnings call. He just sort of reiterates himself. But Chris actually adds something pretty important here. He says, so if you look at Q4 2021, total sales and marketing divided by total new members, you'll see that the overall sales and marketing per new member was down nearly 20% just quarter over quarter. And if you look at this on a full year basis, it was down around 18% when compared to its full year of 2022. And then John goes ahead and asks another question here. He actually says just about rate hikes in 2022. He says, what does that sort of mean in the context of revenues and expenses coming out of the bank, just assuming that we'll go through a rate hike cycle? And then Chris answers back in just the best way possible, saying, our current guidance contemplates 5 rate hikes in 2022, okay? So even if there is rate hikes, those are already placed into our current guidances. If there's not 5 rate hikes, then the guidance will actually be off from what they said, which is even better, okay? He said, that's roughly in line with what's implied by the forward curves today. while staying within the 40 to 50% margin range, by the way. So that's super, super excited that we're going to still stay there. He goes on to say, in Q4, we delivered $105 million of contribution dollars at a 51% margin across our entire portfolio. I just want to jump in right now. I know it's been a longer video, but if you guys could show some support for this video, I'd really appreciate it if you guys give me a like and subscribe down below if you want to see more SoFi content just like this. He goes on to say, in Q4, we delivered $105 million of contribution dollars at a 51% margin across our entire portfolio. He just says this thing. He says, as you know, you can't really look at rate volatility in isolation, as we have a number of levers that we can pull to moderate the impact of interest rate movements, such as pricing, the structure of our loans, and the sale agreements and hedging. This is the true flexibility of what they now have being a bank, right? They can actually just choose which actual products are going to do best and then focus on those products depending on the environment that they're put into. He goes on to say, in Q1, we started to increase our weighted average coupon. That's what he says. It's a coupon rate, okay? It's just like any other interest rate. It's just the amount of income you're taking in from a fixed income product. This could be a bond or a loan or anything along those lines. Anyway, in order to keep pace with rate moves and offset the impact of margin compression that's expected, and demand has remained fairly robust, specifically in our personal loan business. In rising rate environments, our personal loan business does really well, and we're seeing that right now. And in lower rate environments, our student loan refinancing and home loan refinancing businesses do well. Overall, our diversified model allows us to adjust in real time and allocate capital to businesses and opportunities that we do well in. So it's just a way of just turning the dial on what we want to market towards, and then those are the customers that we're going to pick up. So we benefit in all environments right now. Then we have another question. This is actually a big one, or at least a big answer to this question. He says, can you walk us through the guidance assumptions by segment? Okay. Chris doesn't actually answer them full on, but what he does say is that there's several businesses or factors that are not in our current run rate, but will have so much more meaningful impact beginning in Q2 and beyond in this year. He brings up three main points whenever he's talking about this. He says, normalize pre-COVID student loan refinancing originations once the moratorium ends. And then secondly, he says, we expect to be fully originating loans in the bank and benefiting from a lower cost of capital by May of this year, and the extended hold periods benefiting a few months thereafter. This is what they can do actually whenever they have the bank. And then lastly, they say, we'll have the contribution from Technesis following the close of the transaction. Like I said, that's already done by this point. He talks a little bit more in depth, in terms of lending right now. He says, continued momentum in our personal loan business as rates actually rise and folks look to refinance at a variable rate debt into attractive fixed rate loans. Okay. And then they expect to see strong growth in their actual home loan business, for which they'll capture large opportunities that they'll have with existing member growth. Okay. We can't actually pinpoint exactly what they're seeing, but I'm sure they have a lot of data on what they're actually going to see in terms of, what their customers are looking for. And then just full on highlighted this whole paragraph. It all needs to be said. Within financial services, we expect to see continued growth in products and monetization. And the things that are going to drive that monetization are increased assets under management in our invest business, increased spend in our money and credit card business, as well as new product releases, premium services, and scaling our ETFs. A lot of people don't even know that they have ETFs. Obviously, they do. Here are some of them, actually. You can just buy them on whichever sort of brokerage you have. Hopefully, you're buying them on SoFi, right? But they have a whole bunch of different things that through assets under management, we also benefit off that as well. And then they just talk about the actual growth drivers for, the different finance products. So in financial services, in their money products, we see them generating growth, as you know it, from net income and inter-exchange. Inter-exchange is whenever you're actually using your card, the amount of payment that the actual payment terminal's charging for using that card, well, some of that actually gets kicked to SoFi. So that's really, really important. In their invest product, we generate revenue from a number of different sources: net interest income, share lending, payment for order flow, and their digital assets like cryptocurrencies. And more recently, we launched Margin. Okay, I made a whole video on just that, and soon to be options. They've actually said it with their own words that they are going to be putting out options. It's no longer a hunch or, something like this. They are going to actually do it. So that's very, very exciting. And all of these are driven by assets under management, okay? How much money they're actually holding. And we expect continued growth here as our AUM, assets under management, per product trends continue to do very well and our member base grows, okay? And then just going on into credit cards, they say we generate revenue from inter-exchange and balances. That is, just tapping the terminals and just the actual balances. If you don't pay them off, well, then we charge an actual interest rate, right? Our overall revenue per financial service product was up more than 2 times year over year, or nearly 40% just quarter over quarter. That's per product, let alone the actual amount of growth of how much those products actually grew themselves, which was like 2.5 times. That's where we get that 5x, right? Ashwin actually asks another question here. He says, can you give us some clarification on the Pagaya loans, including in the personal loan or origination number? And then Ashwin actually asks another question here. He says, can you give us some clarification on the Pagaya loans? All right. And if you guys don't know this, Anthony Noto actually talks about this right now. He says, Pagaya is a partnership that we entered into that is related to people outside of the credit box that SoFi underwrites. What he's talking about here is that they really only do for people that have FICO scores above 700, okay? He says, we only approve around 30% of our personal loan applications because we're focused on prime borrowers, not near prime or subprime, okay? And so what happens is they actually get these loans, they fill out the actual applications, like he says here, right? Think of it as lending as a service. It's completely integrated with our application process. The credit and approval pricing models are run simultaneously, and the loan is underwritten by Pagaya and a partner. So they're actually having someone else actually take the loan and the credit risk on paper, like they say here. And then what is actually kicked to us is that lead generation fee. So I know I'm going all over because he didn't quite write it the way I read it. This is the first quarter that they've seen any sort of revenue come from Pagaya, because this is a brand new partnership, all right? And we'll actually talk about how much revenue that actually was. They actually talk about it, but it's very, very exciting number, okay? Even though they just started. So we could see massive growth considering 70% of the loans are not touched and we could sell them all to Pagaya. And then just continuing on here, we have another question that says, how are you thinking about the 2022 plans in terms of marketing efficiencies? And Chris Lapointe actually takes this question. He says, the level that we currently need to be at in order to support our long-term is around 30% margin target at a consolidated level. We're seeing really strong cross-buy trends, and as well as you alluded to, that we're starting to feel comfortable about shifting more marketing dollars towards these lower, customer acquisition costs. That's what CAC stands for. And that could be things like referrals, right? It's actually super, super cheap for them to be like, oh, if you want to sign up, we'll give you $15 and the person that signs you up $15. That's actually way cheaper for them than to actually go and, put commercials out on, the Super Bowl or something like that. That's way more expensive. They ask another question here just about their actual direct deposit suite of products that they've put out relatively recently since, SoFi checking and savings. But could you talk more about any progress that there are in terms of getting into direct deposit for SoFi Money customers and what that means for engagement? Anthony Noto takes this question. The numbers are small. They're increasing very nicely. The number of direct deposit accounts that we signed per week increased about 50% from Q3 to Q4, and then another 50% from Q4 into Q1 already. And we obviously just started to introduce the interest rate and the marketing. He said once it does begin, you do start to see a pickup in spending, which Chris alluded to. So the increases we're seeing are steady, positive, and to the right, and we're really just getting started. Remember, once we get spending, that actually leads to more products, these sorts of things, and it's also where most of the actual, higher margin products are. We don't just want people just parking money in a checking account. We want them using it like a full bank, so then we get those inter-exchange fees, right? Whenever they actually tap their card. That's the important stuff. But this is a really, really key point, so I highlight it a little differently. When the Federal Reserve approved our banking license in January, we had to go through a whole product launch. So we had to switch all the technology. They said about everything from affiliates, to reporting, marketing collateral, everything. And that process is still ongoing. This Q1 coming up could actually be a little bit slower because the technology shift, that is going to take some manpower off of just selling the products and actually having to do this whole switch. So 2022 might be a weird year for SoFi, but it's not about the short term. It's about the long term. And this switch is so important for the long term of SoFi, but we could see a little bit slower growth just because of this initial change. Just skipping along here because there really isn't anything that they didn't say that wasn't just already repeated. I did just want to stop and bring up this one point. He's actually talking about Galileo business here, but he says, they're benefiting from the secular transition of physical payments to digital payments, okay? And then he says, this is actually impacting the entire business, right? They're a fully digital bank. So as things start to get more digital and cash becomes more to the wayside and people are more used to using their cards and Google Pay or Apple Pay or whatever, that's just going to get more entrenched into what SoFi does, and more people will be more comfortable using a neobank like SoFi. And then just continuing on, he continues to talk about Galileo in general, right? About the 100 million accounts, we already know that, but he says there's actually growth in their initial accounts that they've already owned, okay? And then the second big growth factor is growth in new partners. And then the third, which is actually the most important one because we've already heard those ones, but that there's international expansion. We have 4 of the largest neobanks as partners in Mexico. We're expanding into Colombia. And now at the back of the acquisition of Technisys, we can enter another 12 markets that they're already in and operating in. So there could be a huge burst of growth whenever it comes to just entwining these two companies of Galileo and Technisys because they have very similar partnerships. He says here, he goes, the business was built on the back of business to consumer or consumer neobanks, but increasingly, we are much more attracted to enterprise businesses, and we'll have a competitive advantage in some of these cases. Enterprise businesses use commercial events, okay? He says, so SoFi Bank could be the sponsor bank to these commercial partners, and these enterprise partners could have an additional 10 to 12% basis point advantage because there's no sweep partners to actually take that additional fee off of. Because we are the sponsored bank, on top of that, the fact that we are also a payment processor. So we just have a competitive advantage versus the other people that might not also just have a bank on their team. Not to mention the increased growth opportunities from the partnership with Technisys and vice versa, which we've already talked about. Next, this other question, just absolutely, we've already answered before, so there's no point in even talking about that. Just skip right through. And then just this last question, this is from Dominic. He said, could we just go back and talk about the mix of financial products within the segments and how that mix really changed in this quarter? Chris ended up taking this question. He said, growth ended up coming from our invest business, which contributed around 32% of that growth, okay? Our money and credit card businesses combined delivered around 42% of that growth. And then Lantern and Pagaya businesses, listen to this, okay? Delivered around $6 million in Q4, which was around 22% of that entire growth. That is crazy to know that Pagaya has already entered in so much growth and they just got started this quarter. Anthony Noto said it was a strong quarter across all products. He's talking about money, the invest accounts, crypto, and robo, okay? And then he goes, but out of those 4 that I mentioned, Robo is by far the oldest out of the 4 products and the one that the team is interested in differentiating more, and we think that there's a big opportunity there to do so. There are still opportunities in every product that we have, although this is probably the one that we've invested to the least and where there's still a big opportunity. And then he goes on to say, he goes, credit cards, I think, actually have a huge opportunity for us. I'm a big proponent. I think credit cards will be one of their biggest products. And he said, we've really just scratched the surface of this, okay? We only have one card. It's not segmented by different types. Should have highlighted that, but he goes, there's an opportunity to make credit cards to work even better with the rest of our products as well. So there's ways to do premium cards that actually have, different membership, things or annual fees or anything, and that it actually works better if you put all your different services through it or whatever. So very, very exciting. Dominic said, and he even added to it, there's not even a question. He just goes, I think you're right and straight to the point. Credit cards, this is a huge opportunity and can really drive up the average revenue per user significantly higher. He asked another question here. He goes, when you think about average FICO score, you mentioned Prime on some of the other products in particular, but just how do you think about the life of loan cost rates whenever we would be targeting these products as you ramp up? And he actually just talks about credit cards, okay? Like, are we going to start losing more, like the lower the credit score that you start to go, the more chance that you actually lose some of your money from people not paying you back, right? That's just what loans are. But Anthony Noto said, credit card products is still a prime target with a very high FICO score that's over 700. Over time, we can explore different opportunities for a broader member base. This means to actually lower those credit scores and actually, take on higher amounts of risk. But he said for right now, we want to build a high quality card base, which we want to drive strong engagement, and we want to make sure that we have a great product market fit before we step out of our comfort zone. And then he just adds that they are running at about a 5.5% loss rate right now, which is relatively consistent with our, personal loan business and is really, really healthy. So it's very good to know that the credit cards aren't doing anything that they weren't expecting already. Now, that is the actual end of the question and answers, but there is just a little bit more that, Anthony Noto actually brings up that's super important. He says, we've achieved more in 1 year than most companies have achieved in a lifetime. He said, as we turn the pages from 2021 to 2022, it started off with more volatile environments and greater uncertainty. This is where the leader of Anthony Noto really comes in. Listen to this. The fog of uncertainty excites me. It creates the greatest opportunities for those who dare to win. It's when leadership matters most because it's when the winners who will take the most are decided. But I wanted to highlight this last part. I even should bold it as well because this is the most important part. I think this is so cool. He said, "For the first time in 4 years, I wake up every day knowing that the only thing between us and realizing our ambitions is us." Okay? And what he's meaning there is meaning there's nothing else that they need. We've got the bank license, we've got everything. It's now just on the team. Before, they were waiting on, these super regulators to just set them up for success, and they couldn't do anything about it. It was out of their hands. Now it's in their hands, and I want it to be in Anthony Nota's hands because this guy is a natural born winner. But that is the full earnings call. And what I need from you guys now is to comment down below if you've guys seen this entire video, okay? Because that means I have some real SoFi fans in the chat and that you guys really want to know more about this company. So I'll continue to put out great videos for you guys. But anyways, that's it from me. If you could, like the video and subscribe down below if you want to see more financial content just like this. Bye for now.